Well, hello everyone. My name is Roger Scott. I'm the head trader for Wealth Press. Today is October 1st. The year is practically, we're going in for the home stretch. My birthday's on the 29th of October, almost the last day of the month, right before Halloween. This is it, and I still don't know what's been going on with the market. It's like a black hole since February. This whole presidential election, the COVID, things are moving too fast. I wasn't here yesterday. I took a private plane to Miami to hang out with Jeff Zinaneri to do a promotion with him, and I'm back here. I got back here at 2 a.m. So if I'm a little bit out of it, if I'm not 100%, got to give me a little rest. It's been a crazy 24 hours. But I wanted to do today's report a little later for two reasons. First of all, I wanted to sleep in a little bit. What can I say? Excuse me. And number two, I'm human. I'm going to be 50 this year. And number two, most importantly, I wanted to wait for jobless claims to come out. So I want to talk about two things. So let's get into it right now. And don't go anywhere because I got something important. I'm going to give you two stocks on my chopping block, setting up for a 4x4 sell pattern. We're going to get into it before I conclude today. Shares in Europe and Asia, they were higher on Thursday, while Tokyo Stock Exchange suspended. Technical failure doesn't happen very often. President Koichiro Miyahara reportedly apologized for the disruption to trading on the world's third largest exchange. 70% of the brokerage trading, both by value and volume, is by foreigners. That is one of the biggest, I think it's the third biggest exchange in the world, actually. Sentiment appeared upbeat despite news that unemployment, we'll get into that in a minute, rose for the fifth straight month in Europe. That's bad. And it looks like there could be potential reclosing again. Concerns that extensive government support programs won't be able to keep many businesses hit by COVID-19 restrictions afloat forever. Official statistics show the jobless rate rose by 8 to 8.1%. That's huge. Can you imagine unemployment rate of 8%, above 8%, in 19 countries that use the euro? That, if you really think about it, and it was at 7.9 in July, now it's 8.1, it's not declining. It's not declining, it's increasing. Unemployment decreasing, that's bad. More closures, that's bad. None of these things were good. Southeast Asia, India, price rose. Quarterly Bank of Japan tanked. Tankan survey showed the headline measures for sentiment amongst large manufacturers stood at minus 27. An improvement from 7 points from the previous survey that came out in July. That's great, but Bank of Japan, things are looking better as far as manufacturing is concerned. But in Europe, jobless claims are increasing, and this is bad. Investors in America are turning their attention to jobless claims, jobless numbers due out tomorrow, and watching to see if Congress and the White House can iron out deep partisan differences to agree on fresh help for the U.S. economy. I would call this iron out deep partisan differences as completely bipolar positions. And crude oil still below $41 a barrel, which means U.S. frackers have to pay more than what they're selling oil at, which means they're losing money, and that's bad for energy prices. Now, we've had jobless claims come out. U.S. layoffs elevated. Let me show you something interesting. I wasn't planning on doing this, but you know how I am. I always fly by the seat of my pants. Actually, I don't. Here's jobless claims. And I think the number's below the 4-week moving average. Let's see, 4-week moving average, 879,000. Yeah, we're on the lower end of the consensus, but here's the problem. They remain high. And that's the biggest problem. The biggest issue is they're moving lower, but they're not moving lower fast enough. And that's causing a major issue. And tomorrow, we still have personal income. That should have already come out. Let's look at that. We've got a bunch of manufacturing things coming out today. Personal income, consensus now 2.5. Look at this, consensus 3.2 negative to almost positive, a little slightly positive, negative 2.7. That's bad. Look at this, personal income, which has moved above pre-virus levels, has been boosted by government stimulus. In contrast to personal consumption's expenditures, which have yet to fully recover. But again, negative 2.7%, where we're revising the number positive. That's not good. And then tomorrow, we've got the employment situation. And what we're looking for in the employment situation is, just to give you an idea, and I'm not looking at the non-farm payroll, I'm looking at the unemployment rate. That's what you want to look at. Consensus is 8.2. I'd really like to see something like 6%, 5.5%. I'd love to see a number that's below 7.1. But again, anything below 8.2 is acceptable. Anything below 7.1 is good. But I'd really like to see a good, solid surprise to the upside. So unemployment, look for a lower unemployment rate. Now, again, I hate to say I told you so, but not only is basic material and industrial leading, consumer, discretionary, and health and technology is all the way down. This is on a 1-month basis. But now utilities are leading. Now, on an average, consumer, discretionary, and technology are still leading, but by a very, very small amount. If you look here, basic materials is at 22.55, and this is at 22.65. So any day now, basically intraday, we could have basic materials switch over. And again, markets are becoming more defensive. Look at what has been leading the last 30 days. Utilities, basic materials, industrial stocks, consumer staples. So you want to stay away from consumer discretionary and technology as much as you can, especially right now. And keep something else in mind. If you look at the S&P 500, we're going to look at it right now. This is going to be our first potential day trading above the 50-day moving average. And remember, if we don't clear, we need 2 days where the low of the trading range is above the 50-day moving average. Otherwise, no soup. That means the low of the day has to be above, and not touch this level. Basically, today's price on the S&P must not come down to 336, let's just say, or 335 something. The moving average, if it touches this blue line, no soup, no soup. And tomorrow. Otherwise, it's going to be a neutral day. And here is my biggest beef. If you go to stocks and you look at momentum levels and you look at the momentum on the overall stock market, this is any stock above $2 that's been trading for 6 months. This is the overall stock exchange. If you look at the number of stocks trading above the 200-day moving average, the number is less than 50, which means the market is officially bearish. But S&P 500, well, it's a little different because markets are capitalized weighted in America. So what happens is the big stocks have a more say in what happens. So in the big scheme of things, on the S&P 500, you've got 58% of stocks trading above the 200-day moving average, whereas the broad market, you only have 47%. So the S&P, those large cap stocks, Apple, Nvidia, those big stocks, they have large market cap and they have a bigger vote. The larger the market cap, the bigger the vote. Where when we look at internals, we're just looking at what percentage of stocks are trading above the 200-day moving average or below, and that gives you a real raw figure. So if you look at the S&P 500, the market is representing itself to be a little extra bullish than it is, and it ain't even all that bullish. It's basically treading on the 50-day moving average line. So you've got to be really, really careful, and right now you got to be defensive. Utilities are leading, consumer staples are leading. Let me show here. Let's go back here. Utilities are leading. That means markets are defensive. Basic materials are in second place. Industrial. All these utilities, materials, industrial, consumer staples, those are defensive sectors, which means you don't want to be a cowboy right now. And that leads me to 2 shorts that have a good high probability of success. First one is Armstrong World Industries. Now, here's the thing about this stock. Notice, it's been trading below the 200-day moving average and mostly below the 50-day moving average. It went up, it made a new low right here. Let me go narrower. It made a new low right here. You could see this little low. And then it went 3 days up, and now it's making a new low bottom. That's very, very similar, very typical pattern for markets. They make a new low, then they go up for 3 days, then they go down. Then they make a new low, then they go up for 3 days, then they go down. So I would be shorting the stock at the 67.95 level, and I would put a buy stop, protection buy stop, at the $71.50 level. Now, why do I not like this stock so much? Well, I'll explain. This stock, it's a Russell 1000 stock. It's in the building and construction right now. They're making plastic products. Plastic products are not used all that much for residential as they are for commercial. And commercial real estate is on the, it's not doing well right now. Residential is. Most building companies, and I'll show you, are really doing well. The fact that this company is sagging is telling us, look at this. DHI, and I told you this was going to happen. Home builders, DHI, Leonard Homes, Fortune Brand Home and Security, Whirlpool, all Deere. These companies are doing well. The fact that this stock is in an industrial or a construction sector and it's not doing well is giving me big red flags. Remember, I'm a big relative strength guy, and this stock is bucking the trend to the downside. Sell it near the 68 level, and if it goes to about the 71.50, cover it. So that's one stock I'm not happy about. AWI, I would sell the stock, and if you're long, I would cut your loss. And if you're short, a good place to get in would be the 60, below 68 level. Next one, I'm back on the energy sector. ANOC. Again, it's also having a 4x4 pattern. Same type of pattern. Makes a new low, goes up 3 days in a row, ready to take off to the downside again. It's called 4x4. Energy sectors, energy is not doing well. As you could see here by the energy sector, when we go to our 10 sectors, the energy sector remains weak by a good strong margin. OKE, ONEOK, one of the weakest energy stocks I've seen. It's been really underperforming the market, and it made a new low right here, a new multi-week low, 3 days higher, and it looks like it's going to set lower right now. I would be selling it on a sell stop at 23 level, and if it goes to the 27 level, I would cut my losses if it trades above the moving average. Now, before you guys go, I know today was a big session, but I've got something important for you. Guys, Joy of the Trades, Jeff Zananeri, is onto something big here. Really, really big, and he wants to let us in on it before it takes off. Jeff's got the same type of experience, the same background that I come from. Institutional hedge fund experience. Jeff's been noticing some serious windfalls with this 3-day profit plan strategy. I'm talking about turning 3,000 into almost 8,000 on Overstock. How about 5,000 into 16,700 on VXRT? And this is the big one here. 4,000 into over 27,000 on Workhorse in less than 30 days. These trades last less than 30 days. Over 100% return, 80% return, or no, 300% return. Let's see here. 1,300% return. Folks, this is life-changing gains. And Jeff is the guy to bring it. This guy had 10 years without a losing quarter. You've got to check this out. I'm not going to miss out, and neither should you. I'm all in. I wanted to check this out. I literally rented a private jet to take me to Miami yesterday and spend the day with Jeff unlocking all of this. Follow the link below. Learn how easy it is to see exactly how you can cash in on these opportunities. Do it now. Again, Workhorse 4,000 to 27,000, Overstock 3,000 to almost 8,000, VXRT from 5,000 to 16,700. This is really good stuff. Jeff Zananeri is the man. These 3-day profit plans, you got to check it out. Follow the link below and have a great day. Bye, guys.